Alright, so the market is still falling and it is terrifying out there for all investors, and so far, my prediction is coming true. I thought, ooh, this is gonna be bad, and it was. I'm a genius. Bo Burnham? Just me? Alright, let me explain what I mean. Papa Powell increased what's called the federal fund rate, which, remember, is the thing that influences all other interest rates. And they increased it by 0.5%, which was the most they've ever done in the last 2 decades. Now, since I was not investing 20 years ago, I decided to look up data as far as what would happen to the stock market when we increased rates by that much. And I shared this really interesting data with you. Across all the different indexes from the Dow Jones, the Nasdaq, the S&P 500, and the Russell 2000, 2 weeks before the Fed increases interest rates, the stock market starts going down, which is exactly what we saw. Even before Papa Powell increased our rates, the stock market was starting to get scared. It was anticipating it, so it went down. Now, research shows that 2 weeks after rate increases, on average, the stock market has also gone down. Now, I made that video on May 4th, which was the day that Papa Powell increased our rates. And 2 weeks later would put us to May 18th, which is the day I'm filming this video. And sure enough, our stock market, at least up until today, is still going down. So everything is lining up. But after that rough period of adjusting, the stock market kind of starts to get used to it. And by the 6-month mark, it starts to recover, and in some cases by a lot. Check this out. Once again, we really start to see the market recover by the 6-month mark, with the Dow Jones up 9.6%, the S&P 500 up 7.5%, the Nasdaq up 9.7%, and the Russell 2000 up 6.9% on average. So remember, once again, the stock market is negative leading up to those interest rate increases. It is negative 2 weeks after the rate increases, but in the long term, it recovers by about the 6-month mark. Now, I said in that video, it might be a good time to start buying into the market a little bit heavier between May 4th and May 18th, and sure enough, the stock market went down pretty substantially and it was a good time to buy. It's just most people don't buy when the market is going down because they're too scared, and most people buy when stocks are going up. They're in the green because they're chasing profits and they don't want to be left behind. So in today's video, I want to see if this thing actually happens, if by 6 months stocks will go up, and I have some new and interesting research to share with you, so I'm excited. Let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for the crystal ball. I'm just kidding, I don't have a crystal ball, but the Dow Jones has reached the lowest levels since June of 2020. The crypto fear and greed index has reached a 3-year low, and tech companies have started their layoffs and their hiring freezes, which is really starting to worry investors. But the craziest part of all is, remember Melvin Capital, the hedge fund that was shorting GameStop? Well, GameStop investors have the last laugh because Melvin Capital is starting to wind down their fund and return the capital back to their investors. GameStop investors are like, yes, power to the players. Also, Papa Powell's the honey badger of inflation because he don't care. He announced this week that he is committed to raising interest rates by 0.5% for the rest of the year, which is the fastest pace since 1994. And I remember investing in the stock market my first year. After an entire year, I was down 10%, and I felt awful. I wanted to quit investing, pull my money out, and never invest again. So if you're feeling the same way, I can relate because so far my stocks are down 11% in the last year, and it looks like there's more pain ahead. So I want to help explain exactly what the heck happened this week and show you some new data about where we're going because it's pretty crazy. The biggest reason why the market is falling is because a few stocks are dragging the entire market down, which usually doesn't happen that way, but it did this time. And one of those stocks was Target. Now, this is kind of crazy, but here's what happened. Target's expectations for their what's called EPS, or earnings per share, was $3.07, which was already a 20% drop for them. But their earnings came out, and it was a lot worse than people even thought, because their actual EPS was $2.19, which was a 41% drop, which is twice as bad as we thought. Now, to make matters worse, the day before, Walmart released their numbers, and it was almost just as bad. FactSet estimated $1.48 EPS, but their actual earnings per share was closer to $1.30. But the worst part is that they also released their forward guidance, which, remember, is the thing that companies use to tell their investors what they think will happen for the rest of the year. And usually companies will use it as sort of like a rally call to their investors to get them excited about what's coming up, right? To increase their share price. But this time, that is not what they did. Instead, they told investors they expected their EPS to basically stay flat for the rest of the year, which means maybe the truth is somewhat worse than they're actually telling us. And when investors hear that, they get scared and they sell off, and that's why the market tanks. Now, you might be thinking, Andre, who cares about Target and Walmart? I don't shop there, I don't own the stock. There's so many other companies in the stock market. Why are we focusing on those two? And the reason for that is because Walmart and Target is the shopping home of America. This is where we get most of our products. And so when these two retail giants are struggling, that tells the rest of the economy maybe other retailers are about to struggle big time as well. And the reason they're both Mr. Struggle right now is because of inflation. So that's why, more or less, the stock market is so crazy out there right now. So let me share with you some new data that I was able to find, which helps explain why we're here and where we might be going next. Here's a really interesting analysis by Canaccord Genuity. In the last 12 bear markets dating back to World War II, 9 out of 12 of them, or 3 out of 4 because school taught me I could simplify my fractions, 9 out of 12 of them have fallen 25% or more. Now, 3 of those bear markets were the worst though, and that was the year 1973, 2000, and 2007, where the stock market fell by more than 40%. Also, the average decline from top to bottom, or peak to trough as it's officially called, was actually 38%. But if we exclude those 3 worst years from 1973, 2000, and 2007, it was actually historically an average of 31%. And that's why if you see it in the media or analysts tell you, that's where their expectations are coming from, because historically on average, we go down about 31%. Now, so far we're down about 18%, which means there's a little more pain ahead, roughly 13% more to go if you believe that history will repeat itself again. Now, I didn't know this before making this video, but this is something we have to be very careful of, because apparently there's something called relief rallies, and these typically tend to happen when the market falls 20% from its peak. Then it starts to go up, and it gets investors excited because they think, okay, the market's recovering again, and these last something like 2 months, but then the stock market falls again, and it's sort of a false rally. Now, this happens from time to time, and if this were to happen to us, this will last until the start of the second quarter earnings season. The only exception to this were 2 times, in the years 1987 and 2020, when we fell and recovered really fast. Now, I'm not saying you should try to time the market, but if you're someone who's older and maybe you want to retire and you don't want to be in risky stocks, those relief rallies are a good time to start selling or maybe converting some of those stocks into bonds. Now, personally, since I'm on the younger side, I'm going to be invested in the market no matter what happens, but I know that's not the case for everyone. Now let me share with you exactly how long those bear markets last based on how long they've lasted before. Here's the most interesting question. How can we use all of this information to figure out when the stock market has reached its bottom point? That's the million-dollar question, because if we knew the answer to that, that's when we would know to invest all of our money when the stock market has reached its all-time low. And that's unfortunately impossible to predict. Or is it? I've put together the closest answer I could to try to figure that out based on historical averages of the past, and here's how you can tell. Historically speaking, even though right now our S&P 500 is down roughly 18%, we are still trading at a price to earnings or PE ratio of 18. By the way, those are both 18. It's kind of weird they coincide, but don't confuse the two. They have nothing to do with each other. Just look at the PE ratio. Right now, it's at about 18. But historically speaking, when we get the bottom of a bear market, our PE ratio has been somewhere closer to 12. So when this stock right here, VOO, and this little thing, the PE ratio, reaches the number 12, that's when we know the market bottom is at least somewhere close. Now, I actually went a step further than that because I'm a nerd, and I averaged out the length of time it took for us to reach the true market bottom after we reached a bear market of being down 20% between the years 1946 and 2020, and here's what I found. The average amount of days that it took for us to reach the true market bottom after a bear market was 285 days. That's how long it took, which means if we continue at this same pace of investors panicking and selling off their stocks, we will reach a true market bottom somewhere around February 27th, 2023, or around the start-ish of Q2 of 2023. Now, as fun as this data is to use to try to figure this out, unfortunately, life doesn't work in averages. For example, in 2020, it took us 23 days to reach the market bottom, but in the year 2000, it took us 637 days, or almost 2 years to find it. So as fun as it is to use the law of averages to predict where we kind of are, we're never going to be super accurate, but it is a good place to start. Now, the thing that I'm paying attention to right now is the stock market's drop. As soon as it drops that 20% mark year to date, that's when I'm starting the clock. But I will say, there is one thing that can change all that, and here's what that is. This time it could be different, and it actually kind of is, because there has only ever been one other time throughout history when the stock market was in bear market mode while interest rates were still going up. Just one other time, and that was March 1974. The stock market was down 22% already at the time of the first rate hike, and the stock market didn't reach its true bottom until it was down 48%, which happened 6 months later. Now, thankfully, so far, we're not in a bear market yet, because we're not down 20%. But we are dangerously close. If we get a bear market in the next week or two, which I'm hoping we don't, but if we do, hopefully the market will have recovered by the end of October or beginning of November. So it'll be really interesting for me to look back at this video to see if the data backs me up. But this time inflation is really crazy. The housing market's insane, supply chain problems, an invasion in Europe, the tight labor market, everything's insane. But mark this video and send it back to me 6 months after the bear market, because I'll forget, but it'll be really cool to see if the data backs me up. As always, have a wonderful rest of your day. Smash the like button, subscribe if you haven't already, go grab your free stocks, all the links are down below, and then go track them automagically with a spreadsheet linked down below in my Patreon. Love you, thank you so much for watching this video. I'll see you back here on Monday and Friday, sometimes Wednesday. I'll see you soon. Bye-bye.